Hello, everyone, and welcome to the Emerging Manager Growth Show. My name's Guy Costin, founder of Dakota. I'm joined by my colleague Tim Dolan and Anna Blumenfeld. Welcome.
Hey, Guy.
Love having you guys here. So this is episode 4 of the Emerging Manager Growth Show. Our whole goal is to answer your questions about growth, the things you need to do to grow. So the format of this whole show, we started with RAs as a highlight. Then episode 2, we did emerging manager programs. And then third, we did consultants. And all of those past episodes are on Dakota videos within Dakota Marketplace. So we have all those replays. A lot of people have been going back and looking at them. So the whole goal of today is, number one, I want you to know on the right-hand side of your screen is where you enter the questions. So please fire questions. This is where we get the most questions. The normal format of this is to demystify fundraising and really talk about all the myths. Today, we're talking public pension funds for an emerging manager. Now, for those of you who don't know us, we founded our firm in 2006, and we've really been an emerging manager sort of distribution firm. So we started with Edgewood Management, large cap growth, when they were $3 billion. Now they're 30 plus. We started with Hamlin Capital Management when they were about $500 million. Now they're $3 billion. So we've always had to work with emerging managers. Currently, we're working with a firm called Spruce. We just started with them about 6 to 8 weeks ago. They're 15 years old, but they really haven't marketed themselves. I say all this in their construction loan strategy. I say all this because we live it every single day. We walk the talk just like you. We're suffering from kind of the same pain points, and we want to be here for you to answer any questions. And so we're going to go through all the public funds. And so with that, do you want to kick it off? So do you just want to dig in, Tim?
Yeah, let's start. We're going to cover the public pension plans today, Anna and myself, with questions from Guy. But before we get into that, I think it's important to just set the table on what is an emerging manager, right? There's a lot of loose definitions, whether it's around percentage ownership, right, being diverse, equity, inclusion, or women minority owned, that qualifies for emerging manager programs. Also, track record, right? So startups or less than 3 years track record, whatever it might be, and then AUM. And what we'll find specific to the conversation today is with public pensions is it's less about minimum AUM, it's more about maximum. And once you hit a certain AUM for these emerging manager programs at the pensions, you kind of hit through that ceiling, you no longer qualify, which actually is a very good thing. Right. So
Tim, as we talk about it, within Dakota Marketplace, our database, we have, I think, 134 public pension funds that we've defined have invested in a fund one with about 387 total funds.
Yeah.
So the good news is we have a really good kind of breadcrumbs, if you will, so you can go in and see all the different public funds that have at least invested in one fund one.
Exactly. And what's interesting when you look at that data, right, it's 134 accounts investing in fund one. So that could even be, right, some of the largest private equity firms like KKR launching a new fund, right? They need to even as a big brand, they need to figure out who's going to invest in a fund one. We have that information captured.
Great. All right, so we'll kick it off. Okay, myth number one, go ahead.
Well, I was going to ask you to go through the myths and then
I'll do it. So myth number one, do I need to wait for a 3-year track record and X amount of AUM before marketing to public pension funds? It's
Absolutely
a big myth, and a lot of people think, right?
Yeah. So just lay out the myths, and then we're going to go through the whole debunking, if you will.
Cool.
So myth 2.
I'm sorry. Yeah. Myth 2, is it a waste of time to call in public pensions because their consultants are the decision makers and everything is search driven? Myth number 3, if my strategy isn't approved by a pensions consultant, is it a waste of time to reach out to that pension directly? And fourth, public equity exposure is all managed internally at public pension funds.
Yeah, so let's go back to myth 1. This goes to track record in AUM. Minimum AUM is what we think about, but for public pensions, right, and it's more specific around maximum AUM. So just touch on, again, going back to the definition specific to public pensions, their definition around emerging manager program and this term around maximum AUM.
Yeah, so one of the things that we'll talk about throughout today's show is that those guidelines really will vary across pensions. So it's not uniform. You don't need a specific amount in assets before you start targeting the channel. It's really going to be specific to that pension. And as Tim mentioned earlier, a lot of that, when it's regarding their emerging manager program, it's more specific to the maximum. So you'll see things like no track record requirements, but it must be a first, second, or third vintage. So that's an example of one where if you're raising your fourth fund, you would no longer qualify for their emerging manager program. But if your first, second, or third fund was in their emerging manager program, those subsequent funds might qualify for the overall portfolio. So that's one of the advantages to getting into their emerging manager program within these large public pensions. And these programs are really designed to help for startup firms get off the ground and then eventually qualify for inclusion in those portfolios. But I think just specific to those AUM parameters too, you'll see things like maybe in one asset class there's no AUM parameters, and then in another there are. So that's why you really have to dig deep on how those guidelines vary across different pensions and different asset classes within those pensions. And then we'll talk about this a bit later, but there's consultant usage as well. Just because two pensions use the same consultant, that doesn't mean they define emerging managers the same way.
Yeah.
So it really is a unique channel with a lot of nuances, and it does vary.
Yeah, and we, as you know, in Dakota Marketplace, we have all the contact information of the key contacts at all of the public pension funds, plus their consultant and field consultant. So it's very easy. And I say that, guys, because you have to be making the calls. You got to be sending the emails, trying to book the meetings in those cities, because you got to get in. We're going to give you this is so much information here to help, but at the end of the day, you really do have to make the calls, because there are opportunities, but if you're not asking and getting involved and having conversations, you're never going to really know.
Yeah, and to that point, right, having the contact information and what consultant they work with, but more specific to Anna's point around each pension plan is nuanced, right? We have that color and that detail listed out, right? As an example, CalPERS, they have no track record requirement for global equities, but on private equity and real estate, it has to be a first, second, or third vintage. So it can't be a fourth. Even if you're below their maximum AUM, they're only looking at first, second, or third.
That's great intel. So if you are in your first, second, or third fund,
Yeah.
that's a email and a phone call you want to make to get a meeting, just to get it on their radar screen.
Maryland State Retirement. For traditional investments, no requirements, but for private market investments, they do have a specific criteria to qualify for their emerging manager program. New York State Common, very specific detail within Marketplace on the platform details of how to access their emerging manager program. Texas Teachers is another one. And then talking about pensions who are actually open to lower AUM minimums, right? LA Fire and Police, public market minimum AUM, they'll go down to 30 million. On the real estate side, they'll go down to 100 million. So if you're just getting up and running and you've got a few clients that make up that 30 million on the public side, right, they'll take a look at you.
And as we know, this is a tough job, right? There's a lot of rejections, there's a lot of no's, but you just got to get out there and be sending the emails and doing the asks.
Yeah.
Because you just never know where it's going to turn. You're never going to know timing-wise where they might be. And obviously right now, the old denominator effect is having a pretty big impact on private equity right now within the public pensions. But they're still allocating. We send out a document every single day at the end of the day talking about all the commitments that have been made this month from 5 public funds, and that's something that comes out daily. So we're still seeing a lot of commitments still happening.
So Anna, you were touching on consultants a little bit and how even some plans use multiple consultants across different asset classes, or even a consultant specific to emerging managers. So just touch on that dynamic.
So we covered consultants on the last EMG show. I think they go really nicely together, pensions and consultants, because you can't cover the pension channel without thinking about consultants. And so when you look at the consultant usage for a specific pension, they typically have a general consultant, an alt consultant, and a lot of times completely different consultants for their emerging manager programs. And there's also a lot of ways they can work with their consultant for emerging manager programs, right? So some might outsource an entire sleeve of the portfolio with discretion to a consultant. Others might maintain their discretion but rely on a consultant either for investment due diligence or even operational due diligence. So those relationships also vary a lot across pensions. So it's really, really important when you're going to call on a specific pension to know exactly what consultant you're going to be dealing with.
Yeah, and a couple examples here, right? Texas Teachers, they have a dedicated analyst in Austin from Grosvenor, Charles Pippin, who works with the internal team at Texas Teachers, right? So thinking about calling on that pool of capital, right? You got to hit from both angles. And then this is a very interesting one, Maryland Terra EM program. This is, as Anna was talking about, kind of a hybrid in their sense, because they use so many different consultants across asset classes. So in public markets, they have 5 different mandates. So U.S. small cap ADX, an emerging manager program. International develop, they work with leading edge. On small cap international develop, they have a different consultant with exponents. And then fixed income is ADX. So you would think, I mean, looking at that, international develop and then having a different consultant for international small cap is pretty interesting.
Yeah, so 3 consultants just in public markets for just their emerging manager program.
Yeah.
So that's why it's so important to know who you're going to be dealing with.
Yeah. And again, back to that point, all of this is in Marketplace, right?
We're just highlighting a few. Obviously, we have literally hundreds. I think probably 800 public pension funds plus.
Yeah.
So, but we're just highlighting some of the keys.
Exactly.
Yeah, so I think key takeaways when you think about consultants and how pensions work with them, it's a couple of things, right? So first of all, it's important to call on the analyst team directly at the pension. A lot of times they will actually, even if they use a consultant, they'll bring ideas to that consultant. So just because you're not already rated at the consultant or approved on their platform doesn't mean it's a waste of time to reach out to the pension directly. A lot of times they'll underwrite their own ideas or bring an idea to the consultant to underwrite if they think it's a fit for their portfolio. And then second, I think making sure you're calling on the right consultant, because as we talked about it, there's a ton of them within one pension. And then lastly, as I touched on earlier, just because 2 pensions use the same consultant, it does not mean they define emerging managers the same way. So don't think, oh, well, this pension uses ADX and this one uses ADX. So, I didn't qualify for this pension's emerging manager guideline, so I wouldn't for this one. That's not the case. It really does. The emerging manager program guidelines are set by the pensions board, not the consultant.
Yeah.
Typically.
And so moving on to kind of our final topic here, going back to the definition of an emerging manager, right? This gets down into percentage ownership, right? So thinking about diversity, equity, and inclusion, diverse women and minority-owned managers. Again, the nuance between each specific pension plan is different in terms of how they define what they want to see from a percentage ownership, right? So Illinois Municipal Retirement System, they need to see an emerging manager minority women-owned business of at least 51%. Then looking at an example of someone that's less than 50% owned, Texas Teachers is saying 33% of the firm's economics needs to be women or diverse owned business, right? Again, we have all this in Marketplace, but it's just important to know if you fit that profile of percentage ownership from a diverse women or minority owned, it could be, even if it's not 50% or 51% and you're closer to 30 or 40%, you're still able to call on these pensions because they have a sleeve dedicated to those types of ownership structures.
And it's important to note, right, we'll just keep coming back to it. You have to send the email. We're going to talk a little later in the show about the exact structure of your email to get the highest response rate. But it is absolutely worth the time if you're an emerging manager to reach out to these analysts.
Yeah.
These are really good programs. They're very focused on them. And it's a very important part of how they think about investing.
Yeah. So I think, go ahead.
I was going to say one last thing to add on the women and minority-owned aspect of these emerging manager programs. I think one common misconception is that all emerging manager programs are just talking about women and minority-owned firms. Yeah. So a lot of times that is the case. Sometimes it's strictly diverse managers in that program. Sometimes it's just a sliver of their emerging manager program. Sometimes it's not really in their guidelines at all, but something they're focused on. And we're seeing it more and more that it's something that pensions are thinking about is allocating to these minority-owned firms, but they're not synonymous, right? So women and minority-owned firms, sometimes it's its own program. Sometimes emerging manager program just means small emerging talent, new managers.
Yeah, it's a very good point.
Great point.
So the one thing kind of before we close out the public pensions, I think is expectations, right, when calling a public pensions, and more so around economics, right? And so especially when you work with the emerging manager programs, and we heard this from Adam Chopin from Exponents when he was our guest speaker, right, is fees. And you have to be knowing going into these conversations, specifically with pensions and emerging manager programs, right, is they are going to provide assets and asset levels to get you to the next level, but they're going to want a large fee break, especially on the long only side, right? You could be charging 100 basis points for your strategy, and they'll come at you with anywhere from 10 to 20 basis points. So just understanding and managing your expectations of, great, I'm going to get 500 million, but it's going to be at a much lower fee base. So
good call. Okay, so as we're moving along, one thing we are going to cover at the end, we're going to go through all the emerging manager conferences. There'll be a slide on that at the end. Tim, next.
Guide to growth.
Let's go.
All right, let's do it.
Okay, so some of this content we had at the end of each show, we slimmed it down a little bit. We're just going to talk about city scheduling and emails. And please feel free to fire any questions at us. We're here to answer them. So as we talk about city scheduling, this is the core, I believe, to being a great fundraiser. And it's very simple, but it's always having each salesperson having a minimum of 5 cities on the calendar at any given time. We've built Dakota Marketplace to make it very easy to do that because it's designed around metro areas. So you can just go in, and our whole goal is to, just as you can see the Boston Metro, it's right in Marketplace. You put 9, 11, 1, 3, and 4:30, and you go into the channels that you want to sell to, and you just go. And always having 5 cities at any given time, because if people aren't getting back to you, people are saying no, the more asks you put out there, the more opportunities you have, and it gives you discipline and focus.
Yeah, and I think the main purpose of this is a organization structure, right? If you're working at an emerging manager, most likely you're wearing many hats, right? And you have a marketing component, client service component, and obviously outbound sales is crucial. And when you get a data set or a list, or you log into Dakota Marketplace, right? That's how many? 15,000 accounts.
Right.
That's a lot to manage, right? So the city scheduling and the metro area tab is specifically built to organize your day, right? So you put Boston on the calendar for January 6th, you write 9, 11, 1, 3, 4:30, leave them blank, and you get those asks out, right? You go to the RAs, you reach out. When you get the meeting, you put it on the board, you put it on the calendar. If you get 4 meetings, right, you're getting on the plane, you're going. What we love about this, right, is it's getting your name out in front of these buyers consistently. And if you only get 1 or 2 meetings, the beauty of it is you flip it to a call, right? And because everybody's so used to doing Zoom now, right? You just flip it to a Zoom. But going through the process of city scheduling, using the metro area tab within Marketplace, it allows you to be more efficient in taking what is an overwhelming list of just the RAs of 2,500 that really matter, meaning they buy what we sell. That's a lot to cover. But within Boston, if I look at it, right, we've got 85. That's manageable.
Right.
You can cover that in the morning.
100%. And we've had a bunch of our members within Dakota Marketplace use this very, very effectively when they hadn't been doing it before. And the goal is just to get the outreach and get the consistent outreach. Now, the key thing is, and what I kind of always think that is kind of ironic about our business is we end up having all these really smart, well-educated portfolio managers, right? But in order to raise money, you have to get face-to-face meetings. There's no other way to do it. And then in order to get a face-to-face meeting, you have to send an email. In order to get the email open, it has to have a very clear subject line. And then it has to have a very clear first sentence and then a clear call to action. Now, ironically, the subject line, right? So if you went to Harvard, you went to Yale, you went to Harvard Business School, Northwestern, whatever it is, we have all these super talented portfolio managers, is they're essentially held at gunpoint by a subject line, right? That's really the irony of it all. But in order to be a successful fundraiser, you just have to accept the fact that you're a professional meeting scheduler, professional meeting setter-upper, and that's the deal. So we always like to have in the subject line, because remember, any one of these analysts are getting 200 to 300 emails a day. And so the simplicity and clarity is paramount. So the subject line we like to do is meeting requests, and they're like, okay, they're requesting a meeting, date and time. And then what you do is you have to give a lot of thought to the packing the punch in 1 to 2 sentences max. And it has to be so clear on who you are and what you do, so they can immediately determine whether they want to take that meeting or not. So, and you can't make them do any work, right? I have a lot of our members send me emails and I'll review it, I'll update it, I'll call them, and then I'll send it back to them. And so then they'll kind of laugh. They're like, oh, you really want to keep it simple? I'm like, yes, you have to keep it very clear, but you have to make it compelling. You have to take what's in your organization and in that strategy and make it very, very compelling. So someone looks at it and says, hey, this is absolutely, I totally get what they do, and this is what we're looking at right now, or looking for, we'll take the meeting. And then closing it out with a clear call to action. That is, you can't say, some people like to give 3 or 4 dates and times and what have you.
Yeah.
I think it's just easier, and then they can come back and say that doesn't work, but this would work.
Yeah.
But the clear call to action is the thing where I see people fall down the most.
It's yes or no. I mean, the best part is when you have this specific call to action, and when you get a response, it just says yes. You're like, perfect. You put it on the calendar and you're off and running. But when you leave it open-ended, are you free in the next couple of weeks? What we have found, and there's a bunch of articles about this, is the Calendly links are actually getting caught in spam now, right? So if you are using Calendly, it may work, right? But some of these, especially in our industry with all these email blockers, right? Those are getting caught up. So a distinct call to action, you want to get the yes. If you get the no, right, you can always come back and ask politely why or why not, right? But at least you're getting a response. And if you show the next slide, I mean, this email is super short, sweet, to the point, and we're trying to get a meeting.
And these work. I'm telling you, they work. So keep it simple, keep it compelling, and keep it very clear.
One question we do get often is, what should I send as an attachment in the email, right? So if you think about kind of doing the job of the analyst for them, the standard fact sheet, the presentation deck, we always, and I like sending the performance if you're a long-only equity manager or fixed income monthly performance, because what they're going to do in Excel, what they're going to do is they're going to download that and put it in their own performance charts, just so they can easily do it and say, wow, you guys actually did well this month or whatever. So fact sheet, deck, and monthly performance. And then on the private side, you can do the same thing from a quarterly standpoint.
Yeah, and don't overthink if you're not getting responses. Just keep sending the emails, keep the city scheduling. It's the only way to raise money, and that's why we built Dakota Marketplace, is continue to send the emails, make the asks.
Yeah.
And now we have the conferences. So these are the emerging manager conferences. All the detail, registration links, and everything is inside of Dakota Marketplace. But as we just review this, Tim, if you want to review it, these are great conferences to go to. You can meet with the different public funds, face to face. Sometimes there are more conference organizers, like with Intelligence. In other cases, it's Texas and others.
I mean, looking at Callan, this is a kind of a big one in March, getting in front of Callan College for investment managers. That Callan is the consultant. They also have Callan IAG, which has an emerging manager program for RAs as well. So that conference alone, you're going to be hitting a lot of different channels from their end client, the consultant, but also RAs. And I mean, looking at this New York City annual emerging manager conference, and then those that took place more recent, Lacers, and then hosted by Grosvenor back in October. Once we get those updated dates for 2023, we'll get those in the marketplace.
Great. And so we have about 500 different conferences in Dakota Marketplace today. We released that about 4 months ago. So that's all in there, registration links, everything. And so we'll follow up with the detailed notes from this with everyone that was on the call. So you don't have to write down your notes, but this is, Anna and Steve did an amazing job. So thank you for preparing this. This is really well done. And like we said, all of this information and all the public pension funds is within Dakota Marketplace. And in January, we are going to do Jan 23rd, episode 5. And this is going to be a focus on emerging managers, how to attack the banks and broker-dealers. And with that, have a happy holiday. Thanks so much for listening. Thanks, Tim. Thanks, Anna. We appreciate it. Everyone have a good day. Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.